Let's talk about Byrna Technologies. Here's a company that is absolutely forging a new category in personal defense. We're talking explosive, triple-digit growth in some of their key channels. A true market disruptor, no question about it. But you have to ask yourself, when you build an empire this fast, is that foundation made of solid iron, or is it starting to fracture under all that pressure? Today on Iron Financial, we're putting Byrna to the test.
Welcome to Iron Financial. Look, our mission here is simple. We forge stronger portfolios by stress testing company foundations. We take a hammer to the balance sheet, we pressure test the income statement, and our goal is to expose the cracks before they become catastrophes for your portfolio. We are starting with Byrna's latest earnings report because, frankly, it is a perfect specimen of a company at a crossroads. We see incredible, undeniable strength, but we also see some pretty significant potential for structural weakness. So let's get the tools out and dive right in. The very first thing that just jumps off the page at you is the raw power of that top line. I mean, look at that number. A 38% increase in full-year revenue for fiscal 2025. That lands them at over $118 million. Now, let's be clear, this isn't just growth, this is a shockwave. This number tells you that the market is absolutely starving for what Byrna is selling, and the company is feeding that demand at a frankly incredible rate. Numbers like this is what builds market leaders. This is what creates momentum that becomes almost impossible for competitors to stop.
Whoa, hold on a second. A skyscraper that goes up in a week looks amazing, right? Until the first gust of wind hits it. 38% growth is the shiny headline that gets everyone excited, I get it. But my job is to read the fine print underneath. For every single dollar of that impressive new revenue, how much is actually sticking around as profit? Is this sustainable, profitable growth we're looking at, or is the company just burning the furniture to keep the house warm? That is the real question here. Are the foundations actually solid?
That's a fair question. It's the right question. And the answer, I think, begins with understanding the engine that is driving all this growth. So, let's move into our first section and see exactly how they're building this thing. We're calling it Forging a Retail Empire. See, Byrna made a massive, really strategic pivot away from a model that was largely direct-to-consumer and launched a full-scale assault on brick-and-mortar retail. And honestly, the execution has been nothing short of breathtaking.
Okay, now, if you really want to understand Byrna's power, you have to look at the sheer velocity you see right here on this timeline. Just follow the path with me. At the beginning of 2025, they're in about 300 chain stores. Not bad. But by the end of that same year, they've tripled it to 900. Now, you add in their independent dealers, their own company-owned stores, and they've blown past 1,500 total locations. And what's their target for this year? 2,000. Folks, this isn't just expansion, this is a land grab. They are planting their flag absolutely everywhere, making sure that wherever a potential customer might be, a Byrna product is right there, within arm's reach.
And right here, this is the direct financial impact of that land grab. These numbers tell the whole story. The retail channel didn't just grow, it exploded. It more than doubled. It's up 104% from $15.2 million in 2024 to $31 million in 2025. This single channel, this one move, accounted for about half of the company's entire year-over-year revenue growth. So the takeaway here, the crucial point, is that the strategy of going all in on physical stores, it is paying off in spades on the top line. They pulled the lever and the machine just roared to life.
And listen, don't just take my word for it. This isn't just our analysis. Management confirms this directly. Just listen to what the CEO, Brian Gans, said on their earnings call. He personally identifies brick-and-mortar as the fastest-growing segment, and that, right there, validates the entire strategic shift they made. It tells us that management knew exactly where the big growth opportunity was, and they aimed every single resource they had right at that target. From a strategic point of view, that is exactly what you want to see as an investor.
But you know, it's not just about being in the stores. It's about how they're in the stores. This try before you buy campaign they're running, especially through their key partnership with Sportsman's Warehouse, this is the tactical genius behind the numbers. I mean, think about it. They are letting customers physically hold and test fire the launchers right there in the store. This is a massive, massive competitive advantage. It completely removes a customer's doubt, it builds their confidence, and according to the company, it drives substantially higher conversion rates. It is a powerful validation of this whole experiential retail model, and it basically turns every single new store into a high-powered customer acquisition engine.
Okay. An impressive engine. I'll give you that. No doubt about it, the growth machine is powerful. But you know what? Every powerful engine burns a ton of fuel, and forging a retail empire is incredibly expensive. All of this heavy lifting, all this rapid expansion,
it always comes at a cost. And that cost, well, it's starting to show up as stress fractures all over the financial statements. So I think it's time we go looking for the cracks in this foundation.
And here it is. This is the first and maybe the most glaring crack in the whole structure. We call it the profit squeeze. Just look at this comparison. On a trailing 12-month basis, Byrna's net profit margin was cut nearly in half. It fell from almost 15% all the way down to just over 8%. Let me put that in simple terms for you. This means for every $100 in sales they make, they went from keeping about $15 in profit to keeping just $8. That is a massive, massive erosion of profitability. The revenue chart is climbing a mountain, sure, but the profit chart is sliding right down the other side.
So where is all this profit bleeding from? Let's break it down. Look at this chart. The deep irony here is that the primary culprit, the biggest piece of the pie by far, is the very same growth strategy that the bulls are so proud of. Selling through dealers and big chain stores means you get much lower margins than selling directly to consumers online. That accounts for almost half of the pressure right there. Then you add on top of that the one-time startup costs for their new CL launcher, the expense of literally moving their ammunition factory all the way from South Africa to Indiana, and a significant ramp-up in marketing to support all those new stores. And what do you get? You get this perfect storm of margin compression.
And this pressure isn't just hitting the income statement, it's hammering the balance sheet, and I mean hammering it hard. This is where the story gets really, really concerning for me. Look at the cash line. Cash is down 40% year over year. They burned through more than $10 million of cash. At the very same time, inventory, that's the product just sitting on shelves unsold, has ballooned by 64%. It's now sitting at nearly $33 million. Look, burning through cash while your inventory piles up, that is a classic flashing red warning sign. It suggests that they might be producing goods way faster than they can actually sell them profitably, and they're funding that difference by draining their own bank account.
And to top it all off, as if that wasn't enough, the cost of just running the business is soaring. Annual operating expenses jumped 29%, from $46 million up to almost $60 million. Now, this isn't just the cost of the goods themselves. This is everything else. Marketing, R&D, payroll for all those new people. The entire machine is just getting more and more expensive to run. So the fundamental question this raises is one of leverage. Is the company's spending getting way out ahead of its ability to generate truly profitable growth? Right now, if you just look at these numbers, they suggest the answer might be yes.
Okay, those are serious points, and you're right to raise them. They are the absolute core of the bear case against this company. But a company under stress isn't a broken company if, and this is a big if management has a credible plan to reinforce the structure. And that is exactly what Byrna's management has laid out. So let's move to Section 3, Rebuilding for Profitability. This isn't wishful thinking. This is the actual blueprint for how they plan to patch those cracks and strengthen the foundation for the next big phase of growth.
And the plan they've laid out is clear, and it's multifaceted. First, a direct lever pull, a 4 to 5% price increase that already went into effect at the start of this fiscal year. Simple. Second, a major strategic cost-cutting move, onshoring their ammunition production, bringing it home. Third, they're actively shifting their sales focus towards their newer, higher-margin products, like the recently launched CL-XL launcher. And finally, number 4, they're engineering costs out of the product itself with a brand-new modular chassis design that they claim has a 40% lower bill of materials. You see, this isn't a wish list. This is an engineering blueprint. It's a series of concrete, actionable steps, all designed to reinforce the entire financial structure.
Let's just zoom in for a second on one of the key pillars of that plan, the onshoring of their ammunition production. Moving ammo manufacturing all the way from South Africa to this new facility in Indiana is a huge strategic move. And this isn't just about patriotism or Made in America stickers, it's about economics and control. Management is projecting this move alone will save the company $1.5 million annually. That's real money. It also reduces their supply chain risk, it improves quality control, and it directly attacks the cost structure that has been squeezing their margins.
$1.5 million in savings. That's good. A 4% price hike? Also good. I'm not going to argue with that. But is it enough? Let's be real here for a minute. Their net income dropped by about $3 million year over year, and that's even after you exclude a big one-time tax benefit they got in the prior year. Their cash balance dropped by over $10 million. So while yes, these are steps in the right direction, I have to question if they are big enough steps to actually reverse the negative trends we've been looking at. I mean, are we patching a small crack here, or are we trying to plug a hole in a dam with a piece of chewing gum?
And this entire recovery story hinges on the single biggest variable of all, execution risk. You know, it's really easy to draw up a great plan on a slide and present it to investors. It's another thing entirely to actually execute it flawlessly in the real world.
Every single one of their promises, from raising prices without killing their sales momentum to actually hitting those cost-saving targets on the factory floor, every single one has to go right. One slip, one delay, one unforeseen challenge, and this whole recovery plan could start to crumble. Remember, the market is competitive, supply chains are unpredictable, a great plan can still fall apart under the weight of poor execution.
And that brings us to our final section, the Iron Financial Verdict. We've examined the incredible force of their growth engine, and you've pointed out the very real stress fractures that have appeared in the financials. So now we weigh the evidence. We're going to put the bull case and the bear case on the scales right here and see which one has more weight. All right, the bull case, my case, is built on undeniable, irrefutable strength. You simply cannot argue with 38% revenue growth. You can't argue with a retail footprint that is exploding towards 2,000 locations. They have a clear, actionable plan to fix the margins, and they are establishing themselves as the undisputed leader in this new category. This company is successfully forging a dominant market position, period. And the bear case is simply the bill that's come due for all that dominance. You can't just ignore the facts on the ground. Margins are getting crushed, they are burning through cash at an alarming rate, and their inventory is bloating. These aren't opinions, these are just numbers on a spreadsheet. The foundation is showing clear signs of fragility under the strain of this rapid construction. You simply cannot ignore the cost of that growth.
And ultimately, the entire bull argument rests on this long-term vision from the CEO himself. He says, "We remain in the very early innings." That quote frames everything. It frames the current margin pressure and the cash burn not as a weakness, but as a strategic investment. They are spending the money now to capture a massive, untapped market for years to come. In this view, the costs are temporary, but the market leadership they are building is permanent. And that's the bet you're making.
Exactly. And that is what this all boils down to. It's a race. It's that plain and simple. It is a race between their ability to execute this recovery plan perfectly and the mounting financial pressures we've laid out. Can they tamper this white-hot, aggressive growth with the cold, hard discipline of profitability and careful cash management? Or will the pressure just continue to build and build until something finally gives? That's the question every single potential investor has to answer for themselves.
So, what's the verdict from Iron Financial? BYRN is a structure being forged under immense heat and pressure. The bulls, like me, see a market leader emerging from that fire, tempered, and ultimately strengthened by the process. The short-term pain is simply the cost of building something that's meant to last. Market Skeptic. And the bears see a structure that was built way too fast, with cracks that are already forming in the foundation. The risk is that the entire thing could become unstable and collapse before the reinforcements even have a chance to arrive. So, is it a solid investment structure, or is it a high-risk trap? That is the question we're leaving with you. You've seen the evidence, you've heard the arguments. Now it's time for you to decide if this is a company you want in your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.